Cramer, welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to save you a little money. My job is not just to entertain, it's to educate, it's to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Sometimes everything goes wrong. Today, everything went wrong. And I mean everything. Stocks, bonds, news flow, counter, you name it, which is why the Dow ultimately tumbled 249 points. S&P lost 0.69%. NASDAQ dropped 0.82%. And this came after a big rally into the close. How could everything be most foul? And yes, how can we still profit from it? Let us count the wayward ways and try to make sense of this market in what seems like a senseless world, but is not. First, this is the first day of a notorious trading month, September, where the market has historically performed very poorly. On average, it's the worst of pretty much all 12 months. Sell. 4 out of the last 5 years, September's been down. Sell. It's averaged a decline of 2% for the last decade. Horrendous. A bear could say, I rest my case. Why is it like this? For starters, lots of reasons having to do with how the year unfolds. In a good year like this one, big institutions take a look at how much they're up, and they axiomatically take profits. Silly? No, it's being responsible. I did it every year at my hedge fund when I was up this big at this time. I was done. Yeah, finished for the year. If you aren't in, you can't give anything back. I sold many of the positions that were in my trading account. I had some investment ones I didn't trade right at this point of the year and just day traded until January. By the way, where do you think I got this idea? I wasn't alone. Almost all the big guns did the same thing. I was taught. Many mutual funds also have years that end in October, so they have to take profits before that for taxes. Knowing that, some big funds try to get ahead of their end of the year calendar year moves, and the calendar doesn't lie. Second, the news flow is insanely bad right now. A federal circuit judge, a court, not the highest court in the land, though, but definitely a high one, ruled that the president's tariffs aren't legal. Hold it. Now, there was a time when this ruling would have been cheered by Wall Street. But they only saw the bad of tariffs, none of the potential positives. In the eyes of most experts, the tariffs were never going to be able to raise any real money either. But you know what? That did turn out to be wrong. The tariffs are raising billions, which helps to offset the cost of the president's big, beautiful budget bill. Again, Wall Street hated the tariffs when they were proposed and mostly still hate them now. But now that the tariff revenue might have to be refunded, the bond market's freaking out about the budget deficit. Plus, the president's team put the fear of the devil into us, so there was no way this negative could be ignored. But the stuff that they said about what could happen was just atrocious. Look, some of it could happen, but now we have to depend on the Supremes, where I'm guessing Trump wins because he appointed a third of these people. But then again, the courts always jump ball. Go ask FDR about that if you see him. The bonds, of course, were hideous. We have a big non-farm labor report on Friday, and the market's almost always turning negative now ahead of any big number. Why? Because unless everything's non-inflationary, quite a rarity, the Fed may look at these numbers and pause its plans for rate cuts. That means a raucous flow of news that bodes poorly for the Fed in general and Fed Chief Jay Powell in particular. Something that the market now really hates because it makes for a really nasty ad hominem backdrop, and we're tired of it. The president's going to get his way on lower rates soon enough, but, well, that's not soon enough for him. When Treasury yields go higher like this, the economy's in danger of faltering. The stocks that did rally today were mostly the so-called wrong ones, the defensive bargain basement retailers that supposedly offer value like the dollar stores or offer real value like the closeout stores. The former has tariff exposure, but that could go away with this court ruling. The latter sell goods where the tariffs already been paid by the original importers. People jumped out of the cyclicals into perma-growth, this typical rotation that can last a couple of sessions at most. More on that in a moment. Remember, what I'm talking about is that they sell the cyclicals to buy, say, General Mills. Even though General Mills isn't doing that well, it doesn't matter. Campbell's Soup, you get me? Safety first also means buying companies that get the consumer's wariness. First among equals being McDonald's, which is sensitive to the avails of everyday American. They were on this morning and they told a story about cutting prices. The worst stocks today, as befits of the horrendous wave of profit taking, are the best ones of the year. That's what I told you about when you get to this point in the year, you start ringing the register, which means the artificial intelligence components we all know about, namely NVIDIA and its compadres. Remember the long knives, which I have to start having a backdrop of long knives. I don't think you can get knives into the exchange, but long knives are what is out for NVIDIA. These stocks are so huge they can swing the entire market. In this tape, one company can be so big with so many tentacles that it can cast a pole and everything else. Finally, we have the requisite worldwide negatives, the axis of evildoers with China, Russia, and now India being thick as thieves, a story that the mainstream media hails as a major breakdown for the Trump administration's foreign policy. Meanwhile, we have a plethora of stories that contend that China's way ahead of us, or gaining on us, or doing much better than us, or maybe we're stupid and they're smart, okay? They own autonomous cars better than we do, what, blah, blah, blah. I always feel inferior these days when I listen to these stories. So what do we make of these? First, let's not jump to conclusions based on a single session. We've seen this way station so many times, and it only ends up in the old winners resuming their advance. Unfortunately, people get shaken out by these rotations, so they miss the next leg of the upside. The fear instilled by commentators, analysts, and journalists often makes it way too hard for most investors who are out there. Stay put. I hope you don't listen to them. Selling creates and begets more selling, and those who don't know what they own get blown out. If you know what you own and why you own it, these days are just garden variety pullbacks, the kind, let's rain for your garden. Now, my poor garden's not been attended to. Then again, for good reasons, as I attended the wedding of our research director, Ben Stoto, out in the mountains of Colorado this weekend. Mazel tov. Best wishes, whatever you want to say. Second best course of action, you just need to sit on your hands and watch. Don't bite on what's rallying. You won't be rewarded as there's no recession coming. That's just a typical throw off the scent move. Food stocks simply don't cut it. Sorry, you don't have shareholder activism and dissent in a group like we have in the food and beverage industry if things are going well. Third, when you hear that the big tech stocks have ridiculous valuations, how many times have you read that? You need to be thinking, how did they get that way to begin with? The answer is because they're the best and they can weather anything. Tariffs, global craziness, antitrust, Chinese genius, you name it. My strategy has been to wait another day and start buying them. There's always a catalyst that turns things around with these growth stocks. Maybe it's Broadcom. Hey, maybe it's Zscaler that got it to the close. By the way, Broadcom is a $1.4 trillion company, and it rallied from down 10 points in the AM to close up 85 cents. Sometimes the rewards for my strategy happen extraordinarily fast. Look at what happened after the close. Alphabet got a shockingly favorable antitrust ruling from a judge who I thought hated them. They won't have to divest Chrome. They won't be broken up in some punitive way for shareholders. And they can still make payments to preload Google, even if they can't have exclusive contracts. Now, this is a huge win for Alphabet, but it's also a big win for Apple, which got paid billions, perhaps more than $20 billion a year to preload Google on their devices. Most wags thought for sure Apple would lose this source of revenue and numbers would have to be cut immediately. It could get even better. We keep hearing, including from me, that Apple has to buy AI, perhaps a Perplexity, to be more of turnkey with Siri. But with this ruling, the tables can be turned. Apple can make a deal with one of the AI bots for that bot to be the exclusive on Apple's 2 billion devices. But get this. Now that bot company, they'll have to pay Apple because it's legal. What a turnabout. Hey, maybe another $20 billion headed Apple's way, maybe more. Those who sold Apple earlier because of a minor story of a departure of another AI researcher ultimately missed the big picture. This is how you don't become a millionaire. Reacting to those kinds of stories. Don't be silly. There's a takeaway for you. Finally, remember who's coming. The cavalry, in the form of lower interest rates and the big, beautiful bills and stimulus. This thing was packed with handouts to industry, and that's great for the stock market. Here's the bottom line. I made a big study of days like today from my book, which comes out at the end of the month, How to Make Money in Any Market. Days like today are the reason why an Apple or a Microsoft or, yes, an NVIDIA haven't made more people millionaires. Days like today are dispiriting, they're painful, and they usually aren't alone. You have to trust the companies you believe in. Trust the market. That's the only way to make big money in stocks long term. And it happens every time there's been a sell-off like today since 1982, when I first walked down Wall Street on my way to Goldman Sachs. Manal in Georgia. Manal.
Thank you, Mr. Cramer, for taking my call.
Of course.
U.S. tariff on Brazil coffee beans is 50%, which has increased retail prices of coffee. Dutch Bros declared adding about 64 locations in the U.S. and have added to the breakfast menu. My question is, in your opinion, is it a good point of entry in Dutch Bros considering the tariffs?
I'm going to say that because I like this stock so much, the answer is yes. But as good as it is, I think people are losing track of a note that I talked about this morning about pumpkin latte and Starbucks. Yes, we've all had some problems with Starbucks being late, blah, blah, blah. But imagine this. We're still going there, and this pumpkin latte is very strong. SBUX. Zach in Ohio. Zach.
Hey, Jim, I appreciate you taking my call. I was wondering your thoughts on Citigroup. Looks like it had broken above some previous resistance around 80. If you think it could benefit from this administration.
I think Citi's fine. I think Citi's fine. It's a good buy here. I do like Wells Fargo more, but Citi's been just a gigantic winner. Good callers. You have to trust the market for long term. In this game, that's the only way to make big money. Don't be the millionaire not next door. On Mad Money tonight, it hasn't been all fun and games for the consumer discretionary stocks, unless you're Hasbro. I'm detailing how the company has set itself apart from others in the group, and why I still think it's got a lot more room to run. Then, as I just said, historically, September is not a good month for the averages, so should investors prepare their portfolios to get defensive? I'm going off the charts to find out. And we know that Taylor Swift is the ultimate influencer, but now her engagement has influenced Signet stock. I'm hearing more about the impact and how the company is planning for a potential engagement boom with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Tonight I want to talk about one of the market's unlikeliest leaders, Hasbro, the iconic maker of toys and games. Here's a stock that's up more than 42% for the year at a time when the entire consumer discretionary group is in the doghouse. And its closest rival, Mattel, is up 2%. This is a tricky moment for anything consumer-related, yet Hasbro's on fire. It's up more than 60% from its post-Liberation Day lows. So how the heck did they pull this off? Regular viewers might have seen this one coming because the CEO, Chris Cox, on the show in early March after Hasbro reported a great quarter, and then again in early May after the post-Liberation Day washout, it was real clear. It was real clear after talking with him. He's whip smart, a great innovator, and a terrific operator. Cox told a just fantastic story of a more focused Hasbro that was circling the wagons around three business lines. First, there's the games division, which owns Magic Cards and Dungeons & Dragons. Very fast growth here, high margins. Then there's consumer products. We were talking classic toys like a Nerf, Play-Doh, G.I. Joe, Mr. Potato Head. Finally, there's the entertainment division, where they license their intellectual property to create movies and TV shows. Again, great gross margins. But to put this very bluntly, Hasbro's stock has been a juggernaut because the company just keeps putting up fantastic numbers. Just like every other consumer discretionary play, this thing sold off hard when the president ramped up its tariff plans, with the stock tumbling from nearly $70 at its highs in February to just below $50 at its lows in April. Even though Hasbro has some tariff exposure, it sourced about half of its goods from China last year. Their big money now comes from games, and most of that's digital. The games business has almost no tariff exposure whatsoever. What really mattered here is that Hasbro's become immensely profitable. When the company reported in April, they delivered colossal, huge top and bottom line beat with more than 70% earnings growth, for heaven's sake, 70%, 7-0. Then in late July, the company reported just another blowout set of numbers with huge top and bottom line beats, and this time management raised their full year forecast. They earned $1.30 per share when Wall Street was only looking for 78 cents. That's amazing. With the latest quarter, Hasbro said it now expects revenue up mid-single digits, MSD as they say, this year, after previously guiding for revenues to be up slightly. Nice. Management raised their operating margin outlook by a full percentage point, too. So what's behind this? Gaming, especially the Magic Card franchise. Through the first two quarters of the year, gaming sales were up 28%. And look, this was it's something that Chris Cox told us was happening right here on Mad Money. He predicted this when he came on the show in March. A perfect called shot, I would say. And I think this part of Hasbro is still not getting enough credit from Wall Street. As for the other large segment, consumer products, that hasn't been doing as well this year, but in large part because of the tariff headwinds. But that's what people still think this company is. Through the first 6 months of the year, the toy division was actually slightly unprofitable. But even that was better than feared. On the last conference call, Cox explained that the consumer products business was experiencing tariff headwinds, quote, as anticipated, end quote. In large part because of shifts in ordering from the company's retail partners. That's what's causing the problem. But he also said that Hasbro expects to, quote, make up much of this delayed ordering, end quote, in the final 2 quarters of the year, and that Europe, the Middle East, and Africa are doing well, as is Asia Pacific. And hey, if the circuit court ruling that we got last week, if it stands, maybe most of the tariffs go away, although my guess is that the case goes all the way to Supreme Court, and the Supreme side with the White House. I think they got 5 votes, maybe an unreliable 6. So long story short, Hasbro is doing well this year because their gaming business is on fire, driven by the excellent performance from the Magic the Gathering franchise. It's a strange name, I know. While the toy business isn't doing as poorly as expected. As for the entertainment side of things, that's too small to make much of a difference. It's nicely profitable, though. But I want you to have one final thought here. If you look at Hasbro's performance by segment in full year 2024 versus, say, the first 6 months of 2025, here's what you'd see. The gaming business has grown rapidly while the toy business has shrank. And you know what? From my perspective, that makes Hasbro a much more attractive investment because their games are high margin and the toys, well, what can I say? They're very low margin, and that's a real tough business. My father sold toys for a living for about 2 years before it went out of business. Toys accounted for 62% of sales last year versus 37% for gaming. But through the first 6 months of 2025, that's flipped. The gaming division accounted for 53% of sales versus about 45% for toys. That's rapidly changing mix is making Hasbro a much better company. Company's overall growth rate is higher, with the sales up 7% in the first half versus down 17% last year. And again, it's much higher margin. Gaming has an operating margin of over 40%. Compared to negative 3.5% margin for consumer products, which brings the company-wide operating margin up to just over 25% through the first half of the year. But of course, this is just really being kept down by that terrible toy business. Basically, Hasbro's gaming division is simply a much better business. It's growing faster. It's more profitable. So as this becomes more of a gaming play and less of a toy play, of course, the stock deserves to go higher. I keep thinking what would happen if they got rid of that toy business. Looking out in the future, I'm betting Hasbro can keep winning with a head of steam for Magic the Gathering, powering the entire enterprise's growth. Plus, the toy division, it could easily put up better performance in the second half. And of course, while licensing their brands to film and TV hasn't been making them that much money, it represents a huge potential long-term growth opportunity. It only takes one hit for these guys to make a fortune, although we did see from Barbie it didn't reflect all that much in Mattel. Best of all, even after this huge run, Hasbro's really not expensive, selling for roughly 16 times this year's estimates and a little over 15 times next year's numbers. That's strange. Oh, it doesn't hurt that Hasbro sports a 3.5% dividend yield. At these levels, if you're worried about already missing the move here, yield says otherwise. Bottom line, Hasbro stock has soared this year because Wall Street still doesn't fully appreciate how much this company's changed. We think of it as a toy maker, right? But its main business is now tabletop and digital games, fueled by the strength of Magic the Gathering. This is a much better business than selling toys, and it's one that doesn't have much exposure to the president's tariffs either, assuming the Supreme Court doesn't strike them down. Basically, this is a gaming stock that still trades like a toy maker, which is why I think it's got much more room to run. Geez, I like this story. Net Money's back after the break.
Coming up, stocks have been riding high and Bitcoin's leading the party. But could the rally be running out of steam? Cramer's charting a course. Next.
Have we gotten too complacent? Legitimate question. After a heinous day where the averages rolled over, in part because the federal court just called the president's entire tariff policy into question. That was last week. And in part because September tends to be a terrible month for stocks, as you will soon see. It's worth wondering if Wall Street's been feeling too bullish. Now, I know there's a professional cadre of bears who never stop hearing from, and they also seep into all of journalism. But stocks have been steadily roaring since April, and there are a lot of bulls out there. Sometimes when there are too many bulls, you run out of potential buyers. Everyone's in the pool because everyone who was going to be positive is already positive. And that's right. Tonight, I want to go off the charts with the help of Carly Garner. She's a brilliant technician. She's a senior commodity strategist, broker at DeCarly Trading, as well as the author of the DeCarly Perspective newsletter. She made a very compelling point over the weekend that I caught sight of. I said, I got to talk about this tonight, noting that anyone who spends much time on social media needs to recognize that there aren't many organic bears in the stock market right now. If anything, she's constantly seeing long and detailed threads insulting the intelligence of anyone who isn't borrowing money to buy stocks, either directly or indirectly. I haven't heard this narrative myself, but there are plenty of greedy investors out there who usually turn into broke traders because they borrowed so much money. Garner notes that this insane, insulting tone is aimed at anyone who holds bonds of any duration or category in their portfolio. And look, it's easy to see how he got there. Risk assets have been gigantic winners since late 2022. Anyone who's had exposure to the stock market or crypto since then has practically been printing money. Who the heck wants 4 to 5% from treasuries when you can earn more than 20% from risk assets? One more point. Garner's spoken to many people who are using AI to pick stocks and allocate their portfolios. FYI, bad idea. I'm a believer in the AI revolution, but there are things this technology can't do well, at least not yet. The big chatbots do not exist to make predictions about the future. Unfortunately, some investors don't seem to understand that. Please, I'm begging you, don't take investment advice from AI. These platforms simply scrub the internet for data and compile it. As Garner puts it, AI, like many investors, operates with a short-term memory bias. It isn't telling us what will happen next. It's simply confirming what already happened. Now, you want Zeitgeist, just go to Reddit, which is heavily scraped by all the bots. Now, in the trading industry, some kind of AI has been used for 2 decades. They call it algorithmic or system trading, and the performance of these computerized systems is just as fallible or even more so than human decision-making. Algorithmic trading is about looking for correlations and betting they'll continue. Computers can do that, but I think it's important to recognize that no professionals are using this technology to make longer-term investment decisions. Let's get back on topic. Stocks have roared for years now, so you feel like an idiot, right, if you're taking a more cautious approach to the market. If stocks keep running and you're a moron for just sitting in bonds, a lot of people feel that way. Here's the thing. We can forget this after a big run, but stocks are inherently risky. They are called risk assets. I know tons of traders who made millions of dollars during the dot-com bubble, only to give it all back when the bubble burst. I could have been one of those people. My hedge fund went negative on the dot-com right near the peak in March of 2000, and we actually made a killing that year. But, of course, it helped that I had started TheStreet.com, watched it open at $62, only to go down to $2. A humbling but learning experience. Still, it's very easy to go all in on stocks when the economy's humming and the market's on fire. That's not why you park a big chunk of your retirement savings in the bond market. That's risk-free money. You keep it in bonds because at some point the economy will falter and the stock market will roll over, at which point you need a source of financial stability. Why bring this up? All right, let's go to the charts. Why don't you take a look at the monthly chart of the S&P 500 futures, going all the way back to the financial crisis. Garner points out that going into today, the S&P futures were bumping against the monthly uptrend resistance. This is the line right here. Now, do you know this tested that barrier three times before? Three times before it. Do you know it's never ended well? This is the 4th time. Maybe it's a charm. I don't know. Sure enough, we're selling off again. Similar to what happened in 2018, okay, and also in 2021. Garner notes that the relative strength, or RSI index, an important momentum indicator, is now forming a double top in overbought territory. In other words, it's saying we've rallied too far too fast. In Garner's view, this suggests momentum is waning and a correction is likely, which is very much in keeping with what we saw today. 2018, the market's rally stalled, but the S&P didn't actually roll over until 2 years later. In late 2021, the process was significantly faster. Obviously, we won't know how this plays out until it happens, but Garner is feeling wary about the current setup. We've seen this move before, she's saying, and from her perspective, the downside risk far outweighs the upside profit potential. That's why she's recommending taking something off the table, because in the end, it's not how much you make on the way up that matters, it's how much you keep on the way down. Speaking of risk assets, now let's take a look at the daily chart of Bitcoin in red versus the S&P 500 in green. Now, this is really cool. Garner's not a cryptocurrency expert, but she can't ignore what she's seeing here. And what she sees is that Bitcoin's been leading the stock market. Bitcoin stopped making new highs in January 21st, while the S&P didn't make its last pre-correction new high until February 20th. Right before it, okay? Similarly, Bitcoin stopped making new lows on March 11th. S&P finally made its last low on April 7th. Why does this matter? Because Bitcoin just made its last new high less than 3 weeks ago on August 14th. If it can't recover, that's a bad sign for the stock market. I'm not saying the S&P should follow in the footsteps of Bitcoin. That's just what's been happening. And if the pattern continues, today's sell-off might only be the first day of a larger beatdown. You know, I'm not thinking that. I am passing on what Carly thinks. Finally, let's not forget about seasonality. This I agree with. Historically speaking, September's a real bad month for stocks. Look at how the December E-mini S&P 500 futures has been trading at this point in the year. This is the 5-year average. Okay, typically the December S&P futures peak around August 31st and then start pulling back, and that is not good. And this is a look, by the way. This is a compilation, January, December 2024. But what matters to me also, because I'm more of an opportunist, is look at this. You get here, if you can stay, boom! But I don't know if you can stay. I want you to, though. Here's the bottom line. The charts interpreted by Carly Garner suggest maybe it's time to pull in your horns. We've had a huge run here, and those don't go on forever, especially when we reach the toughest month of the year. But remember what I say, which is I need you to stay the course. I've seen too many people get blown out right here and never get back in. I want to go to Tim in New York. Tim.
What's up, Jim? It's Tim from Long Island, New York. With more compute driving demand for memory and storage, is Micron a buy?
I happen to like Micron, but remember, Micron has this DRAM, which is a commodity business, and they have this high bandwidth business that is really terrific. And I think right now you'd be driven by what DRAMs are doing, so therefore I prefer other stocks. We do have, and if you're willing to stay tuned, we do have Broadcom reporting this week, and I like them more than Micron. But I feel awful because I like Sanjay Mehrotra so much, but he does have a hostage to some of what I regard as commodity businesses. Let's go to Bill in Massachusetts. Bill.
Jimmy, club member, doing incredible.
Love it.
Thank you. Thank you. You guys are incredible. I'm making a ton of money. I've been trimming for the last 3 months, Jim. I have to. It's just I'm making so much money. It's just incredible.
Look, I have to tell you, you are a wise man, Bill, because the people who don't do that are the people who do not watch the show or play the market or invest. And that's because they're gonzo buy. And you're gonzo in, which I love. How can I help you?
Jim, you know, we got into Reddit. Your daughter got us on that. I'm making a bundle. I've taken all my costs out, plus some profit. I really like Reddit. It's shown profit since it was an IPO. I'd really like to get some more, Jim. Can you give me an entrance point? Thank you.
Okay. Steve Huffman is the most self-effacing of great CEOs of this generation. I like the stock so much. I thought it would come in so I could buy it for the charitable trust. Thank you for the nice things you said. It hasn't. It's down 5 today. I do believe I thought I could get it at 180, 170. I was too chary. Hold on to the stock. It's a winner. Thank you for the kind comments. The charts, as interpreted by Carly Garner, suggest that maybe the bulls have run the course a little bit too, let's say they're too high. But don't get complacent. Just stay the course is my view. Watch more Mad Money, including my exclusive with Signet, shining brightly after reporting better than expected results. And this is, by the way, even with the India tariff that they have. I'm hearing what's driving the strength with Signet's top brass. Then Elliott Partners is taking a bite of PepsiCo, seeking some change. So could this be the force that the food and beverage giant needs to get back into growth mode? I'll give you my take, and it's a little more benign than most. And of course, all your calls rapid fire tonight. So this is the lighting round, so stay with Cramer. All right, what managed to rally in spite of today's overall ugly tape? How about Signet Jewelers, the parent of Kay Jewelers, Zales, and Jared? This morning, Signet reported a healthy revenue beat and an enormous earnings beat. Management raising their full-year forecast. We like this. Now, you know, I've been keeping track of this one for a long time, often speaking with former CEO Gina Drosos about she stepped down in November. We haven't had a chance really to spend a lot of time with the successor. So this is our chance. Let's take a closer look with J.K. Szymanczyk. He's the new CEO of Signet. I hope you don't mind calling you new. I know that's probably a bit of a misleading thing.
No, I'll take it. That's
okay,
great.
But Mr. Szymanczyk, J.K., great that you're here. We have a lot to talk about. I mean, with gold hitting all high, all new, I thought that would be the discussion. But you have a Taylor Swift impact that is probably the easiest way for those of you out there to say, I want a Taylor Swift idea. Give it to us.
You know, we're excited. I mean, Taylor and Travis, their moment to celebrate love really, I think, galvanizes that conversation for so many Americans right now. And we're excited to be a part of it because it's right on par with our purpose. And, you know, Ever the Merchants, we've got a lot of merchandise that really echoes or embodies the spirit of the ring she's got.
Okay, so let's use this metaphor to go into your different brands, because it's really important for people to understand what's Jared different from Kay's. And I figured that maybe you can show us exactly whether, let's say I want a really expensive ring to impress my fiance.
Well, so great question. And I would take you right to Jared, which really is our brand that embodies inspired luxury.
Okay.
The great thing about Jared is not only do you have finished merchandise, but you also got craftsmen on site. So the ability to do custom real time is something that separates us as a large brand. And there's no better example of it than this ring right here. That is a ring that we've turned around custom in 6 days. It is a replica or inspired by, if you will, of Taylor's ring. Now that's also a $100,000 price point item with natural diamonds.
Other than Travis, who can afford that?
Well, I can promise you her price point's a little higher than that.
Okay. Well, I can promise you I'm not drafting into the 8th round. Now, but there's also, it's themed all here, right? More than just that.
Yeah, I think, obviously this is a bridal story, which is going to really resonate more to Jared and to Kay as our milestone gifting. Zale's positioned a little bit more for self-purchase and fashion. So we're moving more of that brand into a space that's targeted on her shopping for herself. There's still a bridal component to it, but going to be a little bit lower price point, a little bit more fashion inspired.
Okay, so we do need to point out the difference between milestone, wedding, and holiday season, but this makes it so that anyone who just thinks, wait a second, it's just a holiday gift, or Valentine's Day, actually right around the corner. This is every week somebody.
Absolutely. I think with a brand like Kay, you're really talking about a brand that reaches the broadest cross-section of America, the largest jeweler in America, and we're there for every gift-giving occasion. So certainly engagement is a big part of that, but gifts for him, gifts for her, gifts for the holiday, any of those significant milestone moments, that's really the bread and butter of a brand like Kay.
Okay, so Laboratory, your predecessor came on, we were worried about Laboratory because whether they held value or not, and we're worried about gold in the impact of how it's too expensive and what those mean for the consumer and therefore for your stores.
Well, let's talk about diamonds first. Mm-hmm. And I say diamonds because we do make the distinction between a natural diamond and a lab-grown diamond, but we talk about them as a category because there is a market and a demand for both. And we see that. When you get above $5,000 price point, that's a more natural-leaning customer. That's somebody that's thinking about holding value as an asset. When you get, particularly in engagement rings below $2,000, that's about maximum emotional value, and that's where Lab really has play.
Okay.
Maybe even more importantly for the future of lab-grown diamonds are a category extender for fashion, which is critical to our growth strategy. It really does make diamond fashion jewelry more affordable in a broader cross-section of jewelry and really makes it accessible for people every day.
Now, gold has gotten so expensive, but I'm not sure how that cuts. I mean, anyone who bought a ring in the last 10 years must be feeling that they made a great investment.
I think gold, who'd have thought that we'd be at these levels, right? But the nice thing about gold is customers know the value, there's a definable market, and they're willing to make that investment. That's probably the most permeable category as it relates to transferring price because people can anchor against it. I think we do feel it a little on the low end in a business like Banter where you've got more $100 and below price points. So that's a little more disposable income exposed. But in the fine jewelry business, which is really the bulk of our volume, we find that it tends to find its level and consumers are willing to pay for it.
Okay, now physical stores, I love the comeback. We've got some terrific same store. Online, you need a little work.
Well, our online business is strong when you look at those core brands. So Kay, Zales, Jared, we continue to drive growth, and we feel good about the progress there. Our pure play digital brands, a little bit of a mixed bag. Blue Nile, we're seeing healthy progress. Seeing growth within the business and really do feel that we're on the right track. We've got some work to do with James Allen. Admittedly, I think we've gotten a little bit out of sorts around customer strategy, and we've taken some time to reset both the pricing and promo as well as our assortment architecture so that we're positioned well for the back half of the year.
Your Blue Nile brick and mortar at Short Hills Mall is gorgeous.
It is. It's a beautiful experience.
It's just really one of the better experiences for Jordan.
Blue Nile really is a nice experience in a number of locations. That's a great example.
In the meantime, you're continuing the tradition. Something I like, which is this buyback of 59 million shares in 2017. You're down to about 40. For people who feel that what is the benefit of being a shareholder of Signet? You make it worthwhile.
Well, we're focused on what we can do to drive shareholder value, and given the discount that we've seen in that stock price, I think it's a great way to return capital to shareholders. We're trying to balance that against our long-term growth strategy, and we really do feel like in the long run, investing in driving comp sales growth, as you saw in this quarter, the slightest movement up in comp sales growth, and we get good leverage on SG&A, we're able to pull that through to operating margins.
No, you sure do.
Striking that balance is important for us.
It's a shame when you put it on a tough day. I think the stock could have really been up 20 points. That's how meaningful this quarter was. So congratulations to you.
Thank you. I appreciate it.
Okay, that's J.K. Szymanczyk. He's the CEO of Signet Jewelers, SIG. And by the way, it's good to see you. No, it doesn't work like that. They have money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Chris Rock, we're going to say the talk to them about my social new close up. I'm not saying for the and then the lightning round is over. Are you ready? Skeet, that's how the lightning round. Everybody, we're going to start with Allie in New York. Allie.
Booyah, Joe.
Booyah.
Booyah. I own AppLovin. I'm up, and I'm wondering if I can buy more here, if I should hold.
No, I don't want you to buy more. As a matter of fact, it's up 50%. Let's take a little off the table just to be prudent. It's a monster stock, and it's very well run, but a little off the table would certainly make me feel better. How about Gary in Alabama? Gary.
Hey, Jim, I understand regional banks are doing well these days. What do you think about Ameris Bank Corporation?
It's very good regional. I think you're absolutely, you read the market very well, and I'm not going to recommend anything other than owning bank stocks. Let's go to Jesse in Rhode Island. Jesse.
Hello, Jim. Can you hear me, brother?
You sound fantastic, Jesse. How about me?
Booyah, man. First-time caller. I'm a young engineering student and investor at WPI. My inquiry is a clinical-stage biotech company. Stock analysts report as a moderate buy, having outperformed the S&P by 60%. Jim, what is your humble opinion on FDMT, 4D Molecular Therapeutics?
Okay, here's the way we're going to approach this. This is a pure spec, okay? I mean, total spec, $300 million company, up 10%. I say you own it, but count it as part of your speculative part of your portfolio and no more than that. Let's go to Jeremy in Florida. Jeremy.
Booyah! Big Boca Raton, booyah!
I like your ad. You obviously had a great weekend. What's going on?
Yes, sir. Long-time listener, first-time caller. I've been listening in since the Kudlow and Cramer days. That's how long it's been.
Oh, come on, man. That is ridiculous. No one's over 105 who watches this show.
So first off, thanks for the great advice. I'm a teacher, and I pass it along to my 8th grade students, and you make me look like a genius. Thank you,
Well, I thank you for teaching, okay? Thank you for teaching. We don't have enough great teachers. How can I help?
I appreciate it. My interest tonight is SITM, side time. Is it buy, sell, or hold? What's your advice?
This is just a very good company, and it's going to have a big earnings. It's going to have a big earnings turn. It's just is it cats and dogs? It's all the stuff that goes into just the regular mobile phones, which I think are making a comeback. Okay, I know I'm alone on that, but maybe I should say you're with me. Let's go to Peter in New York. Peter.
What's up, Slim Jim? Big booyah to you.
Thank you for that. Thank you for this from this 31 waist guy.
I'm calling about the darlings of Arlington, the biggest, baddest home builders in the U.S. of A. Give me your thoughts on D.R. Horton.
I like D.R. Horton. I see your D.R. Horton, and I raise you with Toll Brothers. Let's go to Doug in Louisiana. Doug.
Hey, Jim, first-time caller. Enjoy your show.
God, fantastic to be on the show.
I'm looking for a stock that might be immune to tariffs.
Okay.
And is generating consistent income. Mm-hmm. Saw a company that advertises has been in business for a long time, and I wanted to get your thoughts on Lamar.
Typically, I would not recommend an advertising stock. This does have a 5% yield. They're very clever guys, and it's not a high multiple stock. It's not my favorite. I think advertising is not a good business, but that is the best of the lot. So there you go. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Unless your head is stuck in a bag of Frito-Lay potato chips, you now know that Elliott Management, one of the smartest, toughest activist firms on earth, has taken a major stake in PepsiCo and wants change. What's the change? Actually, that's not how it works with Elliott, at least initially, because there's a ton of bluster reportage about what happens when this uber-smart hedge fund takes a stake. But I can tell you that most of the time it's misplaced. If you study Elliott, as I have, you recognize that these guys aren't gunslingers and they aren't pirates. They are thoughtful, intelligent people who do a tremendous amount of work, and they want the stock they invest in to go higher, something that the company CEO should want too. When CEOs discover that smart activists, and not all activists are smart, have taken a stake and want change, I tell them to welcome thoughtful activists, sit down with them, work with them, even consider it like hiring a great management consultant for free. See, Elliott in particular always does an immense amount of work. They have ideas you may be missing. You do need thick skin because remonstration can be very tough. But these guys aren't on a mission to throw out executives who are willing to listen and learn. However, if they don't listen, if they're intransigent, then it becomes a very different story. Why? Well, because unlike, say, Kraft Heinz, which is demerging today and is watching stock go down because the brands they're unleashing need total overhauls, PepsiCo has tremendous brands that could be worth a lot more than the company stock is selling for. Comparisons, my mother always told me, are odious. But PepsiCo had always sported a premium price earnings multiple to Coca-Cola, in part because Frito-Lay is a remarkable food brand and PepsiCo is a great growth beverage company. But that's no longer the case. And that's a real negative turnaround. PepsiCo has assets all over the place, and turning the company into it's like an array of cats and dogs that cannot stand. The truth is they've made acquisitions that made sense, but then lie foul. Think SodaStream, or there are perfectly good companies like Rockstar that are virtually being given away to Celsius, a beverage company that reminds me of Gatorade when it had monster growth for PepsiCo back in the day. I know that CEO Raymond LaGuardia has been dealt a difficult hand. See, if you had to invent a food that could be stifled by GOP-1 weight loss revolution, it would be Frito-Lay. The old ad from the 60s was, I bet you can't eat just one. But that's almost precisely what GOP is allowing you to do. You can eat 3 or 4 maybe and be very full, as they still taste great, but you just can't eat a lot of them. They're trying to solve this by selling smaller bags, albeit at high prices. That's not going to work. Frankly, I'm not sure what I would do. I don't really have a solution for GOP, but that's one problem. I don't have a solution for this whole Generation Z that seems to view their bodies as temples. Can't bring down the temples. Maybe the solution for PepsiCo is Siete and Poppi, 2 excellent recent acquisitions, but you can't be all things to all people, and you can't support all of their brands. Like Quaker Oats, you're supporting all sorts of different drinks and different foods all over the place. There has to be a core to the business, and I don't feel there's a core there anymore. Otherwise, we'd still own Pep for the charitable trust like we used to. I don't know what will happen here, but I would say that the stock isn't up enough after today, given the agitation I expect from the smartest activists in the business. I would say, though, that if I were running the company, I definitely want to brainstorm with Elliott. PepsiCo can, and again, will be, if they listen, the premium food and beverage company, but not if it keeps being run the way it's managed now. Like I said, as always, bull market summary, pumps right front just for you right here at Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.